Hello and welcome to my channel. I'm Delight, and at the end of this tutorial you should be able to define what a balance sheet is, give its use, and you should be able to draw up one. Please subscribe to my channel and hit the notification bell to get notified each time I upload a new tutorial. A balance sheet is a financial statement which shows all the assets and liabilities of a business, as well as its equity at the end of a financial period. Assets are any resources that are owned by the business. Fixed assets are the resources that are bought with the intention of not to be resold and are expected to be used in the business for a very long time. Examples of such assets are office furniture and motor vehicle. Current assets are the resources in the business that are expected to be sold or used within a year of business operations, and examples are inventory and cash. Liabilities are the items that are owed by the business. There are two types of liabilities: short-term liabilities and long-term liabilities. Short-term liabilities are the items that have to be paid within a year of the business operations, and examples are creditors and bank overdrafts. Long-term liabilities are the items that can be paid after a year, and an example is bank loan. Equity represents the value that would be returned to a customer's shareholders if all the assets were liquidated and all the company's debts were paid off. Equity can be represented by the equation equity is equal to assets minus liabilities. Here is the layout of a balance sheet. There is the name and date on which the balance sheet was made. In this exhibit, I'll be using Nadia's balance sheet as an example. The first entry to be made in the balance sheet is fixed assets. In this case, we only have a motor vehicle valued at $2,000. The next entry is current assets, and there is only one, which is inventory. The next step is to subtract current liabilities, and in this case, we have creditors valued at $40. The difference between current assets and current liabilities is called working capital. Working capital is the value of resources of a business that can be easily converted into cash. The value of the working capital, which is also known as net current assets, is added to the total value of the fixed assets. The next step is to subtract long-term liabilities, but there are none in this case, therefore the total becomes $2,660. The final part of the balance sheet shows the owner's equity. Under capital, there's cash introduced and net profit for the year is added. Drawings are then subtracted and we get a value of $2,660. Notice how this value is equal to the value that is in the first section of the balance sheet. This brings us to the accounting equation. Assets minus liabilities is equal to owner's equity. It is called a balance sheet because at any time, each side of the equation should balance out. That's it for today's tutorial. Please like and share the video. If you have any questions relating to this topic, please leave a comment in the comment section below.